Well, good morning, good afternoon to all of you who are joining us on this monthly call. My name is Laurent Kssis. I am the head of Europe for Hashdex. And today we decided to continue our sessions and lead this in conjunction with our Brazilian colleagues. So I'm pleased to have Samir and João with us, who are going to talk today about the volatility nature of the crypto markets. And we've got quite a few things going on, as all of you may be aware. The market has been very turbulent. So we want to discuss a bit about the stable coin and the algorithmic stable coins. We want to discuss also some of the centralized finance as well as decentralized exchanges and their liquidation issues. And on top of this, we're going to add a bit more on staked ETH. So welcome to today's call. I'm just going to have a quick housekeeping. So this is going to last for about an hour. Samir and João will discuss about the markets. It will be a very informal, ongoing chat, as if us three would discuss this on our regular weekly calls. There is a disclaimer. This is an educational piece. We're not here to talk about any investment, and at no time are we discussing any listings or investment advice. So this will purely be an education. We'll go on the next slide. So today, Hashdex comprise of around $500 million in assets. That represents just more than 260,000 investors. We are in Brazil, the #1 crypto asset manager, where we listed the Hash, our flagship Hash 11 crypto basket. And that was developed in conjunction with our index manufacturer, which is NASDAQ. So this is the NASDAQ crypto index. Hashdex today was created in 2018, so just around under 4 years. Started very humbly with the business in Brazil and Latin America, and is backed by a leading venture capitalist community. Mostly you will have heard of SoftBank, as well as Valor Capital, and we also have Coinbase Ventures. So we exist today really to bridge the traditional finance with the crypto economy, and we're here really to support that and help you going through this very difficult environment. And we're hoping we can do this in a very simplified manner. So we, as I mentioned, we work very closely with NASDAQ. NASDAQ is our strategic partner. We have co-developed the index, and the idea is to try and capture the markets. And NASDAQ does that with many other indices, but they're working specifically with us on the crypto markets. And we have co-developed the NASDAQ crypto index, as well as listing a product in Europe on the Swiss exchange called the NASDAQ Crypto Index Europe, which was slightly tweaked to adapt to a European regulation. Where certain tokens were not eligible to admission. So we had to tweak it slightly, and NASDAQ did a great job in doing this. So we feel that we're capturing the markets. We have a thematic angle, and we continue to list products where and when we can onto the European and world exchanges. Today, we are a global player. As I said, we started listing the first groundbreaking crypto index ETF on the B3, which is the national Brazilian exchange, on April 21st last year. We then came up with an agreement and partnered with Victory Capital, which is a huge player in the US, about $160 billion in assets. And we entered formally the US market through various distribution channel that Victory is now supporting us. In August, we launched the 2 single assets, ETH and Bitcoin ETFs on the Brazilian exchange. And in conjunction with Victory and Nasdaq, we filed the NCI ETF in the US as well. So that may be unknown to many, but is also a very important milestone that we achieved back in August of last year. In February, we started our path in Europe and created Hashdex AG in Switzerland and incorporated the company, which then came very closely with the launch of the first Nasdaq Crypto Index Europe work that we did together, Hashdex and Nasdaq, on the Swiss market, listed in US dollar, euros, sterling, pound sterling, and Swiss francs. Obviously ongoing, we've got quite a lot of plans and ambition, and we hope that you'll stay tuned how we develop this business both in the US and Europe. And as of now, then I'd like to continue with our monthly call. As I said, I'm joined by Samir, who is our CTO Product and Research, as well as Jean-Marco on the portfolio management side. And we will discuss the environment today, the title being Understanding Crypto Volatility Nature. Over to you, Samir. Samir, can you hear me?
Samir?
Hello, everyone.
Okay, there we go. So I'll let you take the floor and discuss what you're seeing right now. Let's talk a bit about correlation and what we're seeing in the market.
All right, let me chime in here. Thank you, Laurent, and thank you all for attending our monthly call. So the first question that I bring here is why we're talking about macro in a crypto asset monthly call. And of course, there's a good reason for that. In the first decade of the existence of crypto assets, we could say that they were really uncorrelated with most of the traditional assets, or the most relevant traditional assets. So the correlation was always bouncing around zero. And by 2017, became a relevant thesis for investment in crypto, the uncorrelation with traditional assets. But after the COVID crisis, we had a different picture. We have a different level. We still have moderate correlation most of the time, bouncing around 20 or 30%, depending on the window that you're looking. There was a spike in the very beginning of the crisis, but afterwards it stabilized around 20 or 30% correlation. I'm talking about equity markets. And so it was a moderate level. And more recently, after the fourth quarter, 2021, we saw the correlation climbing up and up. And this is the graph that you can see on the right side. This is the rolling correlation 2 months between S&P 500 and BTC, Bitcoin. So it departed from around 20% and reached 8% in May. So it was a very relevant increase. And it happened to all the risk assets, not only S&P 500. We have some possible explanations for this phenomenon. One very old in terms of theory and finance in general is that in crisis periods we have more correlation between risk assets. The common factors became more relevant, and they drive all the markets in the same direction, the same swings in all the risk assets. We also have, when we compare, for example, with 5 years ago, we have a different level of maturity from on the crypto assets. So there's less volatility coming from idiosyncratic factors. So it makes the correlation grow with the the higher relative relevance of common factors with traditional risk assets. And we also have the presence of institutional investors investing both in traditional and crypto assets. So they react to the same, let's say, risk aversion, liquidity needs, and so on. So these are some of the possible explanations that we see for this phenomenon of the high correlation that we're seeing right now. So this is the main reason why it's relevant to talk about macro when we analyze what happened to crypto in the last 6 months.
So Jean-Marco, when you're looking at this graph, what exactly are we looking here? Are we saying that at the moment the correlation of Bitcoin to the S&P is around 62%? Is that how we look at it?
Yeah, it goes up to 80%.
Sure.
In May. So
why do you think that has dropped down a little bit now in the last couple of weeks?
It's basically for the idiosyncratic events that Samir will present afterwards. So we were basically going with the macro news flow, and we had some relevant internal crypto events that Samir will explain.
Okay.
That decoupled a little bit, but it's still very high.
Understood.
So I think we can go to the next slide, please. So let's talk a little bit about the macro environment. As most of you know, we had a negative scenario overall. We have the COVID crisis, the reactions from the governments, both in terms of economics, injecting lots of money in the economies, and also the sanitary measures that they took. For example, we have the lockdown in China right now. So it's a very severe supply shock, negative supply shock. We have also the Ukraine war, which is very relevant, especially for commodities, oil, natural gas, soy, several commodities were impacted. And as a consequence, we have global inflation rising, and we have a monetary tightening to respond to this inflation scenario. And there is also the possibility of recession, especially in US. So in the scenario, we have two effects on risk assets price. That's the present value of future flows. The recession shrinks the future flows, and the raising the interest rates makes the discount factor higher. So when you take these future flows to present, they are more discounted. So we have two effects that impact the present value of risk assets right now. So this is what we're seeing. And in this graph that we have on the right, we have S&P 500, Nasdaq 100, and the NCI in blue. The scales are different. In the left side, we have the equities, and in the right side, we have the NCI. The difference in the scales was intentional. We have 2.5 times the right scale on the left, on the right scale compared to the right, and it's basically the volatility ratio between the NCI and the Nasdaq 100, which is mostly technology companies. So these two effects that I mentioned, they also impact most of the crypto assets. They will deliver technology. They are a technology that will deliver valuable services in the future, but in a recession scenario, they worth less, and they are more discounted right now. So it's expected that this scenario also impacts crypto assets. There is one exception, at least in theory. Bitcoin in its final goal as a store of value should not be suffering from these effects. But what we see right now, it's the speculative phase of Bitcoin as a newborn technology is prevailing. So it's also suffering, such as the other crypto. But we can say that in relative terms, it's holding way better than the other ones. So, and it's also relevant to show that when we take in consideration the risk or the volatility, what we see that we have very similar returns since November from NCI, Nasdaq 100, and S&P 500. S&P 500 dropped 88% of annualized volatility. Nasdaq 100 dropped 91% of its annualized volatility, and the NCI dropped 96% of its annualized volatility. So they're going in different paces because they had different volatilities, but the magnitude is quite similar. So what I mean is that crypto, what we see in crypto right now, this drawdown for the NCI, which is around 70%, is mostly explained by macro factors. But we also have some idiosyncratic factors affecting the markets, the crypto markets, that Samir will explain right now. Thank you.
Great. Thank you, Jean-Marco. Over to you, Samir. Let's hear you out.
Yeah, no, sure. So exciting times. Like Jean-Marco explained, like most of these dropping crypto prices can be explained by the macro environment we're living. There is really discounting risk assets. There are also some idiosyncratic or crypto-related events that are affecting this asset class right now. So it is both like a time to be careful, but also can represent opportunity for the long term. So we like the way we see the crypto ecosystem and the digital asset class is as a strategic investment for the long term. So this is a new technology, one that is being developed and is being tested as we speak, right? So it's like any technology, it takes time to develop, it takes time to evolve. There's a lot of projects that would fail in the way, but the few that will remain that will create a lot of value. So it was like that during the internet phase. It was like that during the personal computer phase. So just like any new technology, it's a new wave, takes time to develop, and there's a lot of risk, but also a lot of opportunities, right? And what we're seeing right now is basically the macro environment is looking bad, as you can see. Prices for all risk assets are dropping, and also as I will show here, crypto prices have been like dropping even more than the traditional market, I'll say, the equities. There recently, in the last 2 months, there were at least 2 events that happened in the crypto space that basically created panic in the market, created liquidity crisis, or like made the price drop severely. And this is what I'm talking about. I will describe a little bit about what happened in those 2 events. One was during May, and now a second one in June, consequence of each other, and try to explain a little bit what happened and like the nature of this. All right. So if you have any questions, please feel free to put on the Q&A side of the Zoom or on the chat. Okay, so that we can answer any questions you might have. So I'll start explaining this like the first phase here. Let me get here. So on the like CFI and DeFi liquidation. So this event happened now in June, right? So it was like 1 week ago. It basically happened as a consequence of this market dropping so severely. There was a lot of players that were highly leveraged in this space, right? And what we're seeing now is a deleveraging of the industry right now, right? So in the past few days, we've seen a growing concern about those centralized entities that may be facing a risk of insolvency, right? So we heard about Celsius, Babel, there's a restructuring happening with BlockFi. All of those names, they are basically lending platforms. So they raise money from retail institutional investors, and they basically lend those assets out, both in DeFi and decentralized finance, a lending protocol, but also on what we call CFI, or to other players that basically create a credit market within crypto, right? And one of those players is Three Arrows Capital. It's a crypto-focused hedge fund. So those companies, they've been on the spotlight list recently because they've been through what we call a liquidity crisis, right? So it's a bank run, people redeeming, asking for redemption on the money they deposit there. And since like most of those investments are basically staked in high risk assets or high risk protocols, those entities are facing a liquidity crisis, which is basically they cause a huge market impact to redeem their positions to pay out their creditors, right? And this is what we're seeing right now. And one of the main actors or one of the main I would say components of this is what we call stETH. stETH is basically a service, a decentralized service that runs on Ethereum that offers what we call liquidity staking, right? So staking is basically when you deposit assets to secure the network, and you receive a reward as a yield for securing the network. And Ethereum, the main smart contract platform, has been passing through an upgrade to convert from proof of work to proof of stake, right? And during this upgrade phase, this transition phase, if you stake Ether, if you deposit Ether to secure the network, you can't redeem it. So you can't redeem it until the transition is fully completed. And it should take, estimate says that we should take around 1 year now to complete this transition. So there is a service on the Ethereum ecosystem called Lido. And what this service does is basically allows you to deposit your Ether and receive a token called staked Ether in return. And then you get what we call liquid staking, which is basically you are eligible to the staking rewards, but you have a token that is liquid and that can be traded. So in normal conditions, those pairs like Ether and staked Ether, they trade at the same price, right? So they trade at parity. But when you have like a run for safety or people redeeming their assets, that's when prices start to decouple, right? And we can see in this chart here what we call liquidity crunch, increasing the Ether discount, which is basically a lot of people selling staked Ether for Ether, right? And since you can't redeem staked Ether for the actual Ether in the ecosystem, you create a discount, a natural discount on the prices when you have like a large sell pressure. And Celsius, which was the first one to basically start like announcing that they were facing problems and blocking withdrawals, they have a huge position on staked Ether. And as you see, they have a lot like big positions on Bitcoin and Ether as well. And this is just in one of the lending platforms, DeFi lending platforms called Aave, right? So once those collaterals started dropping in pricing, what they saw is basically like a wave of liquidations. So it was not only Celsius, any player that was leveraged on staked Ether, doing what we call in the DeFi ecosystem, we call it yield farming, which is basically leveraging the position and investing in DeFi protocols to increase the yields, right? Using those yield farming strategies, you can get yields from 5% to 15, 20% a year. So it's very relevant, it's very attractive, but of course, there's no free lunch. There's a lot of risks, right? And one of those risks is that, like, if price drops, then you get liquidations. If you get liquidations, you basically, and you are highly leveraged, you can basically lose everything you invested in. So what we're seeing right now is a lot of institutional players that didn't have, I would say, conservative risk management approaches. They are facing those liquidations. They're losing a lot of capital. Retail investors are also taking large liquidations, and this can create a spiral effect, right? And what we call a run for liquidity, which is basically the assets that have more liquidity are liquidated first, right? Because you can transform, you can basically turn into cash with a smaller price impact. So that's what we've been seeing, and this chart here shows basically the price action of like the main digital assets this month, and you can see that Bitcoin and Ether, they underperformed the other assets, and I'm showing here Polkadot, Cardano, and Solana, right? So we can see the blue and orange line here are Bitcoin and Ether, and the others are the altcoin or those other smart contract platforms. They have less liquidity. They are generally more risky. They have a higher volatility. When we are in the risk-off scenario as the one we're living now, they tend to underperform Bitcoin and Ether because there is a flight to safety to Bitcoin, which is the safe haven in the crypto space. But right now we're seeing Bitcoin dropping more than those assets and Ether dropping even more. And the reason is because of those liquidations, right? So because most of those institutional investors, they carried a large position. They basically deposit Bitcoin and Ether as collateral to take US dollars and stable coins for collateral, for leveraging, right? So they have like a huge position in Bitcoin and Ether that is collateralized. And now we're facing those liquidations, and that's why the prices are dropping. And another interesting thing to note here is that since everything is transparent on the blockchain, we can actually see for those DeFi protocols, we can see what the liquidation price is and what amount of tokens are going to be liquidated for each price level. So here, it's a simple example. It's Bitcoin USD liquidation curve. So it's W Bitcoin is basically is a Bitcoin token represented on the Ethereum network, right? So it's basically how you can use Bitcoin on the DeFi protocols. And you can see here that there's a huge liquidation on $13,000 now. So this is the current snapshot of the market right now. So what we can see here is that if prices drops to something like $14,000 or $13,000, that can trigger a wave of liquidations. And when you have those wave of liquidations, the prices are severely impacted because you basically have a huge amount of capital that is being dumped in the market at the same time. And this is basically what happened here in this, let me show you here in this phase of the market here, the blue arrow here. There was a large liquidation pool at around $20,000. So this is what happened during this weekend, right? During this weekend, the price reached $20,000, and that triggered a wave of liquidations that made the price drop from 20 to like 17,000, something like that. And then you can see that it returned, and it's basically stabilizing around $20,000. So it's a risky moment. We don't know basically the spillover effect and if that can trigger a spiral of other liquidations. Right, so here is Ether prices. Also, like you can see, huge liquidation prices, liquidations at $900. Here around $700 as well. You can have like a lot of capital being liquidated at those prices, right? We still don't know if there's going to be spillover effects. Other players may face liquidity crisis, and that can make the short-term price action they make it hard to have a recovery on the short term. But the interesting thing that I like to point out here is that despite this huge stress in the market, and this is even bigger than the COVID crisis, right? So the deep liquidity crisis we faced during the beginning of the pandemic, the DeFi ecosystem is working flawlessly. The smart contract platform solutions, so Ethereum and all the other players, they are working as expected. So they are not failing. What is failing is the central institutions, the prop traders that were like working highly leveraged. They may be facing hard times. They may be taking severe losses, but the actual decentralized finance protocols, they are working as expected. And what we expect is that they will come out stronger after this severe stress in the market. So that's why we keep, like, despite the short-term negative, the short-term risk, there's a lot of risks in the market. We don't know if this is the bottom. The prices can go down like even further because of those liquidations and also because of the macro scenario. So there's two components playing out here. But for the investors that are really looking into the long term, are looking for crypto as a strategic investment for the long term, as a technology investment, this can represent a good opportunity because prices are being discounted by short-term risk aversion and panic in the market. So this is basically the silver lining. This is what we believe here. This is what we're here for. So Hashdex is specialized in offering investment strategies and investment solutions for crypto, right? Because we believe that this is a nascent asset class and we're just in the beginnings, right? So so this is the message that I wanted to point out to you guys. So in the short term, there's a lot of risk in the market. There is a deleveraging or cleansing in the marketing being performed now. Some players may face huge losses. If you are going through a conservative approach in crypto, which is just buy and hold, which is like what we believe in, you should be safe, right? So you'd be concerned about custody and how you invest those assets. There's no risk of losing your investments if you are just on spot on plain vanilla investment strategies. But like for those who are leveraged, this can be a very tricky moment, I would say, Laurent.
Mm-hmm. Let me ask you, when you were on the Celsius loan on ETH, I think that's a bit further up down page 25. Obviously, the stETH is currently at its highest. There's a little health rate at the top showing 2.07. What does that actually imply?
So it's basically the health rate. It's basically how the position is being collateralized, right? So the level of collateralization of the system, right? Okay. Which can represent I would say a risk of those positions being liquidated.
And what is the factor? Does it go from 1 to 5? What kind of strength does that show at the moment? If
I'll have to check up here. Okay. What is the health factor of this pool specifically? I'll check that out and share to you in a minute.
No, because what is interesting is obviously on the wrapped BTC on the ETH network, you know, this is quite a small amount in comparison, right? So what is interesting is that the exposure is not so much on Bitcoin, but definitely on the Ethereum, the staked Ethereum, and that's, you know, $500 million is quite considerable. So that's why it was just quite interesting to see what kind of representation that meant.
Yeah, so it's basically it's over collateralized. So when the health factor reaches 1, you get liquidated. So okay. It means that you are like with 2, you have the double of the collateral. Sure.
Yeah, and these liquidation, maybe you might want to discuss a little bit. They're all on chain, or they're happening off exchange. They're happening on exchange, which generally might not be on chain. So how is that influence in, you know, the actual, let's say, stress factor for selling Bitcoin and selling ETH? Do you have a view on that?
So they're happening both on-chain and off-chain. So
Okay.
on this chart here, we're only showing what is happening on-chain. So
Okay.
the liquidations on the actual DeFi protocols. But like I said, there's a lot of centralized institutions. They're also engaged in lending and borrowing activities. So there are what we call off-chain liquidations. Those liquidations, they tend to happen on centralized exchanges and OTC markets, so over the counter. But the on-chain liquidations, they normally are performed on the decentralized exchanges, right? So what we're seeing now is pressure on both markets. So both the decentralized and the centralized market. The good thing I was mentioning previously is that on the decentralized side of it, it is working as expected. Right, so liquidations are happening, it's part of the game, but the protocols, they are healthy. So if you are basically lending assets to those protocols, you're not facing losses because all positions are over collateralized and the liquidations are happening as expected. But on the centralized side of it, you are getting some systemic risks out of this because you have like a small set of players doing huge operations and facing a counterparty risk on each other, and if you don't manage that collateral and that risk in a diligent manner, you can have some permanent losses there and some severe losses. So that's the kind of like the main narrative in the market when you see like Three Arrows Capital and other like players, Celsius, Babel, BlockFi, all those names coming in the headlines. They are related to the centralized side of this. So it was too much leverage on the centralized relationships within crypto on the network of counterparties, centralized counterparties in crypto. On the decentralized part, there was not too much leverage. There was leverage, but this leverage is being liquidated now in a healthy way with no systemic risk. But on the centralized part it's where the danger is.
Sure, and I think that makes total sense on the centralized part, because that's what we're seeing in conventional markets as well, right? The liquidation. So I guess for the benefit of our listeners, what might be interesting, Samir, is can you just explain how a liquidation is triggered? So when you're looking at, for instance, this graph here, and we're looking at Bitcoin, and at the level where, let's say, would it be around 13,000 here? How does that happen? What exactly is triggered, and why is there such a big gap?
Oh yeah, so the gap is basically when you're borrowing money from those decentralized protocols, you need to post collateral, right? So the loan to collateral rate, it's the client that defines. So you can define the level of collateralization that you want to face in. They're normally working in a I would say conservative manner, posting a lot of collateral for borrowing those positions. And basically the level of collateralization will define your liquidation price, right? So how much collateralized you are will define your liquidation price. So this is basically a calculation on how is the level of collateralization of the current loans, right? And what is the estimated liquidation price for each of those? And once the price, once the price gets closer to the liquidation price, of course, if you are a borrower, you can deposit more collaterals, or you can close out the positions, right? So this doesn't mean that once prices reaches, I don't know, $14,000 here, all those assets, $400 million in assets will be liquidated because the players can reduce their leverage, they can close out the positions, they can post more collaterals as the price gets depressed. But if you get to the liquidation price of your position, then basically your collaterals will be open for basically any DeFi actor to do what we call like an arbitrage trade, which is basically liquidate that position for the protocol and get a spread out of this. So they get incentives to trade that position to convert this to pay back the loan. So it's a very clever approach where you can do this fully decentralized, and you can count on market actors and on economic incentives to make the system work healthy.
That's great. Thank you. So the message I'm hearing from you is really that there's been far too much leverage. These collateral positions are now being called, and that's what's really pushing the market. So do you believe, to what extent are we reaching now a low, or this could continue? Do you think that there is still very much a lot of leverage outside that needs to be called? And to what extent we're likely to see this period going?
No, this is a great question. So since this has been a very hot topic recently, we believe that the players that can provide more collaterals or reduce their leverage without liquidations, they are doing this now. And that's why we're seeing the liquidation, like the big wave of, like the big volume of liquidations dropping now to around $13,000 on the Bitcoin, because people are deleveraging their positions. Getting liquidated in those platforms is very painful. So you pay penalties on this. You can lose a lot of money if you get to the liquidation point. So basically, only institutions that are they're under stress right now will let the liquidation price reach without like closing out the positions. So like taking a snapshot of the market right now, it doesn't look there is a lot of positions on chain to be liquidated. So on the on-chain side of the landscape, so on the DeFi protocols, we don't see too much leverage in the system right now. The positions are being unwind, but on the centralized side is a black box. We don't know, right? So that's the risk right now. That's why we need to keep like a close attention to what is happening and how like Three Arrows or Celsius, how those potential insolvencies will cause problems to other players and potentially creating a domino effect on those centralized players that are engaged in leverage and borrowing and lending. So this is still like thing to be careful. It's hard to say. $20,000 it's a huge support, let's say. So it's the top of the last market cycle, has been like historically a very turning point, I'll say, in crypto prices. So on the bright side, like if we can keep and pass through this stress scenario without like being too much breaking the resistance or the support of the $20,000, we can see it like a short-term recovery to the I would say stress phase. There wasn't around $30,000, so that was like this table, like basically the price we were trading before this big liquidity crisis. So there's hope. We can see the $30,000 soon once this crisis passes. If we see a severe liquidation and prices drop like below 15,000, then can be like very dangerous for crypto. Also, I'm only considering here the idiosyncratic events, but like João Marcos said, there's a lot of macro risks out there. So there's high inflations, the Fed and the tightening, the war in Ukraine. So there's a lot of things happening in the world right now. So it's very hard to call it a bottom. But I would definitely say that if you're looking for long-term investor horizon, so if you're looking for like 3 to 5 years investment horizon, then this might be a good opportunity to start like considering strategic investment in crypto.
Sure. And obviously, what we're offering with the NCI is capturing the markets. So that's supposed to apply as a cushion and help, obviously, mitigating the risk, right? Along now, of course, there is definitely market cap weighted, so Bitcoin and ETH takes precedent. But by capturing the market, you're trying to reduce that blow, and that's supposed at least to help mitigate and diversify your risk. And that's a reason why we are working closely with NASDAQ to promoting this. And I guess also on the back, the demise of Luna, which we haven't really discussed, that obviously has been affected. We can clearly say to our audience, we didn't have Luna in our baskets, so that will have helped as well. And these are, reason, like you've mentioned, that we're supporting this narrative by finding the right approach and the right solution. So thanks for this. Jean-Marco, is there anything you'd like to add? Is there any questions, maybe? I'm not seeing any questions right now.
There's a question in the chat right now. Do you consider any alterations in the underlying methodology of the NCI and NSCIE based on current volatility?
Yeah, that's a great question. So, like the NCI started, like, dated back in 2018. So when we started Hashdex, we designed the Hashdex Digital Assets Index. And what we really intended with the methodology, and that spirit is reflected on the NCI, is have like a robust benchmark for crypto that both can represent the market, but can represent the market that is investable by institutional investors, right? So there's a lot of filters there. So it's just not just price and market cap. We really try to be to build a product that institutional investors can invest, can replicate. And that's why we've been able to launch this as an ETF in Brazil. And it's one of the, I think it's the most successful multi-asset product, crypto product globally. So really, the methodology is very strong. And that's why projects like Luna weren't eligible for the methodology and weren't part of the index, right? So there's no, we don't anticipate any alterations to the methodology itself because the methodology is very robust. So we have different filters, eligibility criteria. So the assets must be supported by regulated crypto exchanges. It must be supported by institutional crypto custodians. Both exchanges and custodians, they are vetted by NASDAQ, right? So they need to go through NASDAQ's due diligence process in order to be eligible for this methodology. It needs to have a minimum level of liquidity. And then on top of that, you have the NASDAQ oversight committee that basically does this, I would say, health check and due diligence on the assets itself. So it's just not any token that Dogecoin or any of those meme tokens, they wouldn't be eligible if they don't really show that they have robustness and they have investment case. So that is one of the advantages of the NASDAQ crypto index, right? And so the methodology itself, we don't see any potential changes on the methodology. But of course, if one of the assets on the index itself faces a huge fundamental problem, like the one that happened with Terra and Luna, then the NASDAQ oversight committee may take actions to take the asset out of the index, right? So they have a very conservative and proactive stance in how they run this index. So that's why we think this is it's a very robust product for the long term. So it will not be fast to capture the new asset, the trend asset or the meme token, but it's really for the investors that are looking for the long term and they're looking for a very secure and diversified way to invest in crypto.
Excellent. I do not see any other question. I think we have another 5-10 minutes to go. Is there anyone else who would like to raise their hand or comment on some of the events that we've discussed so far? Okay, I guess that's going to be it. So obviously, we want to continue these monthly sessions. We're very delighted that you've been able to take some time and join us today. We will definitely push for another one. There's a lot of things going on at the moment in the markets, and we really believe that you need to stay tuned. Sometimes you don't have time, and as a result, that's where we're here to provide these sessions. So we, on behalf of Hashdex, we really want to thank you for participating today, and we are always available for any questions if you have anything you want to ask later on. So don't be shy, and obviously, stay tuned. There's quite a lot of things going on, and we really appreciate you participating today. So thank you very much. And we look to seeing you again next month. Thank you.